Hey, Jordan from Condo here. Today I want to go through a quick market update. There's lots of anecdotes floating around. The market is heating up. We're starting to see bidding wars again. So I want to dive into the statistics, some recent home sales, show you what we are seeing in terms of prices before we draw the conclusion that the Toronto real estate market is back. All right, so this is the first listing that I want to show you. This property out in Niagara Falls, a detached home, was listed for $699,990. Holding offers, of course. They then went on to sell 3 days ago for $830,000. So sold considerably above asking price. So a lot of people, a lot of agents are looking at these numbers and saying, well, the market's back, things are on fire. And while there is really low inventory, it's important to take a step back and look at where prices were just 1 year ago. So funny enough, this exact home actually sold a year ago. It sold during the absolute peak of our market in February of 2022, and it sold for $1.2 million. So yes, today it did sell in a bidding war just like it did in February of last year, but the difference is the price. So instead of selling for 1.2 million, this property only fetched $830,000 in today's market. So while we are starting to see signs of life in the market, we're by no means anywhere near where we were this time last year. This is another listing I quickly wanted to show you. So this one just sold 8 days ago for 4.6 million. Nice, large luxury home in North York in a great neighborhood. But I want to zoom in here on the listing history. So you can see that this listing sold for 4.14 in June of 2020. It then went on. Charles, get out of here, man. We've been interrupted by my number one agent. All right, sorry about that. So for this listing history, what we see is sold for 4.14 in June of 2020. Then in September of 2021, sold for $960,000 more, okay? And then this month, it just resold for $500,000 less than the previous sale. So it just goes to show how volatile the market has been in the last 3 or 4 years. And it's also worth noting that it still sold today in today's market for considerably more than it sold in 2020. So by no means are we back to sort of pre-pandemic prices in any market. And honestly, I don't think we're headed there. And the reason I don't think we're headed there is because we are seeing signs of the market picking up, not slowing down. We're not seeing signs of it getting worse. We are seeing signs of it getting better. Now, of course, this could be a very short-term blip in the market. It could maybe be because people think that they're safe and that interest rates are no longer going to hike, or maybe it's that people are very optimistic and they actually think that rates are already going to start coming down. But what we're not seeing is a flood of inventory into the market. We are still seeing very low levels of inventory. So this chart from Scott Ingram on Twitter is the 416, so the Toronto proper months of inventory. And if you're not familiar, months of inventory is just a distillation of if you are in a buyer's or seller's market. So it is how many listings you're getting in a month versus how many sales, essentially absorption rate. Anything under 3 months of inventory is a seller's market. Anything sort of between 3 and 5 is a balanced market, and 5+ months of inventory is a buyer's market. So you can see that early this year, we had a spike in months of inventory and the market was anemic. Like nothing was happening. Nothing was selling. Nobody was buying. But in the last 2 weeks, I can tell you that things have picked up considerably. We're still very low in terms of volume trends. A lot of people still playing the wait and see game, but prices are starting to push up a little bit. So this is the Habistat dashboard, which just uses sort of the TREB sales numbers. There's a little bit of a lag in reporting. So these numbers will sometimes differ slightly a little bit to TREB's Market Watch report. But I just want to show you the trend lines here. So this is across all regions. You have Durham, Halton, Peel, Toronto, and York on the chart. You can see that prices have come off considerably since peak. And then you hit January and February of this year, and we're starting to see prices in almost all of the regions, almost all markets, start to push up just a little bit. Nothing insane yet, and a trend that may not continue at all, but we're definitely seeing signs of life. So Ben Rabideau posted this on Twitter. This is the cumulative national house price decline from peak in this year's market crash and some of the previous notable market corrections. Okay, so you have 1989, you have 2008, 2017, and 2022. What I want to show you here is that across all of Canada, so across the Canadian Real Estate Association, you're looking at house prices on a national basis. We are down about 15% from February of 2022 versus today. Why that's interesting to me is that it makes this the largest decline, the largest 1 year correction in Canadian real estate history, at least going back to the 1970s. So a lot of people, especially on Twitter, like to think that there's far more pain to be felt in the market. I tend to disagree. I would say the vast majority of the pain has already been felt. That doesn't mean we're not going to continue to see some price regression in the market. That's just to say that the large decline has probably already occurred, and anything from here will be sort of a slow sideways grind, or maybe a little bit of a grind down, or maybe a bit of an incline. But regardless, I don't think we're going to see anything groundbreaking happen this year. But I also wanted to talk about affordability. So it's worth noting that if you had bought $1 million property in, sort of the peak of our market, January or February of last year, and you had an $800,000 mortgage, so $200K down, at 2.35% mortgage rates, you would have paid $3,524 a month. Now, let's say if that property is 15% less today, and so you can pick that same property up for $850,000, and let's say that instead of doing 20% down, you still put the same $200,000 down payment on the property, and you took out a mortgage for the remaining $650,000 balance at today's mortgage rate, let's say about 5%, your $650,000 mortgage today would actually be more. So it would be $3,777. So the point I'm making here is that property prices have declined less than buying power has. And simultaneously, you would kind of expect, given the mortgage rate increases, that we would see more mortgages in arrears. We would see more defaulting happening in the market. Isn't really the case. You're starting to see it trend up a little bit now, but nothing that noticeable. And while we are seeing more power of sales today than we were any time previously, it's mostly relegated to people who had privates, and often multiple privates. Zooming into the condo market here, I wanted to break it down by region. So if you're not familiar, I put up the map here. So CO1 is the most interesting district usually to look at. It has the most volume, so it's most indicative of the overall market, or tends to be. And CO1 is sort of the downtown core. So anything in the downtown core of Toronto, you look at the average selling price in January of 2022 versus January of 2023, you're seeing a 9% decrease in price. But of course, buying power has dropped considerably more than that. So all things considered, condos in the core are holding up quite well. CO8 is the sort of east side of downtown. You're looking at negative almost 10%. C15, North York, Bayview area, negative 15%. Then you have Leslieville, 9%, and W06, so sort of your Humber Bay area is where most of that trading volume happens. You're looking at negative 11.3%. Now, if instead we take a look at detached and you look at January of 2022 versus January of 2023, you'll see that Toronto detached down 18%, York down 17%, Peel, Halton, and Durham all down more than 25%. So generally speaking, the further you get from Toronto, the more price regression you're seeing in the detached market. All things considered, roughly 25% in some of these suburbs and exurbs markets. And I think you can take a look at this and go, well, Toronto condos and Toronto detached seem to be holding up a little bit better than other property types, which is to be expected because you're starting to see a little bit of a reurbanization of demand with people moving back downtown. And also Toronto as a whole, the 416 as a whole, that market appreciated the least through COVID. So you saw areas like Barrie and Hamilton run so aggressively, 60 to 80% over a 2-year spread, whereas Toronto didn't do quite as well, and condos in general didn't do as well. So of course, they tend to be the better holding up asset class today. Now, the final point I want to make is on the pre-construction market. So obviously that's what I deal in primarily. Pre-construction market's still slow. We have people on our team who dedicate almost their full time to resale properties. They are quite busy. Things are definitely picking up for them. Pre-construction is a lot busier today and in the last 2 weeks than it was early January. But we're still a slow crawl with maybe a sprained ankle, right? So new projects are not selling out in a weekend like they used to. And I don't anticipate them to for the rest of the year. But I want to point out a couple of supply and demand factors here for the long-term outlook. Short-term, I think it's interest rates game, right? But long-term, and I know I say this all the time, but the picture's looking as bullish as it ever has. So 3 headlines from Urban Nation. Number 1, Toronto developers expected to delay 10,000 units as slowdown hits condo pre-sales. Number 2, rental apartment construction slumps. So we've seen a contraction in the amount of new purpose-built rentals being built because of building costs rising and staying elevated as well. And then, of course, Ottawa aims to welcome 500,000 immigrants. So we're seeing the fastest immigration we've seen in a long, long time here in Canada. So if we're short on housing, why are developers not launching product? Well, they're not launching product because there isn't demand. There isn't demand for a couple of reasons. Number 1 is obviously nobody really wants to pick up extra investment properties when they're not sure what the next couple of years looks like. Number two is the cost of construction has elevated a lot. Municipal levies have come up a lot. And of course, you have new legislation like inclusionary zoning making developing condos more expensive. And so what we've seen is resale condo prices haven't really changed for the last 2 years, but the cost of new condo units from a developer has gone up massively. So the gap between your new condo price and your resale condo price has spread quite considerably. In some cases, for apples to apples comparisons, I'm seeing 35% spreads. So, you look at a new condo launch and you say, is there a 2-year-old building right across the street? If there is, oftentimes you can pick up a resale unit in that building for 30% cheaper than the pre-construction condo. So the few investors that are in the market are focusing their efforts where they can get the best deals. And that would be the resale market and the assignment market, where you can find some distressed sellers. But unfortunately, the cost to build has inflated. And so developers have no choice but to either launch their projects at higher prices and hope for the best, or just not launch their product at all. So if they don't have mortgage debt on the land, or they don't have a specific reason why they have to launch today, well, they're just postponing it. And that's why you've seen 10,000 units shelved. And simultaneous to 10,000 units being shelved, well, you're seeing all-time high immigration and you're seeing a contraction in purpose-built rentals. So this is going to, over the long term, mean that we're going to have even less affordability. You have less new units launching, which translates to less condos on the market, which also translates to less rentals on the market. And so rental prices and property prices over the medium to long term, the outlook's not good unless you are an investor already. So that's sort of my take on the market and what I see over the next, short term, long term. Let me know what you guys think in the comments below, and please like and subscribe. We're getting close to that 10,000 subscriber number, and we're going to do something fun. I don't know. I'm going to try not to copy Tom's story on my giveaway, but I'll figure out something once we get a little bit closer. Again, guys, thanks for watching, and I will see you next video.